Hello and welcome to Quilter Cheviot's Markets Uncut podcast, your weekly insight into the topics and issues that we have been discussing here at Quilter Cheviot. Remember, so you don't miss future episodes, be sure to hit the follow button on whichever streaming platform you are listening on, or by following hashtag QC Weekly Comment on LinkedIn. I'm Andrew Cartwright, investment manager based out of our Birmingham office, and this week I'm delighted to be joined by a regular commentator and head of fixed interest, Richard Carter, and Nick Wood, our head of investment fund research. Welcome, Richard and Nick. So last week was very busy in terms of central bank activity, with the US Federal Reserve and the Bank of England both meeting to discuss interest rates. And the much anticipated outcome of those meetings was that interest rates remained unchanged across the board, and this leaves rates in the UK at 5.25% and 5.25% to 5.5% in the US. The US Central Bank met the week before, and they also left interest rates unchanged at 4%. There were also various other reports released, and we saw that unemployment in the Eurozone has increased from 6.5% from its previous record low. And the US jobs report also showed signs that the labour market is slowing in America. The Eurozone inflation figure for October was also published and came in lower than expected, down to 2.9% from 4.3% in September. So Richard, Andrew Bailey, the governor of the Bank of England, had commented back in September that the UK was now much nearer the peak of the interest cycle than before. And in doing so, he was perhaps signaling that the bank was beginning to focus on the risk to the economy if interest rates remained too high for too long. But with interest rates unchanged in October, presumably the latest inflation figures still didn't justify cutting interest rates or indeed increasing them. What did you make of those interest rate decisions, and perhaps just as important, the comments that accompany those announcements? Were they in keeping with your own and market expectations? And did any of the other economic reports announced last week stand out as being particularly noteworthy?
Yeah, thanks, Andrew. I think last week, you saw actually quite a lot of relief in bond markets on the back of what the central bank said and what the economic data actually showed us. I think I'd characterise it that we kind of think central banks are near the peak in rates, and there was plenty of evidence to justify that in the UK and Europe over the last month or so. It's quite clear that the UK and Eurozone economies are slowing, but the doubt was a little bit around the US. The US economy, very resilient, still very quite strong inflation, still strong labour market. And the concern for markets was that, the Fed wasn't done and would have to keep hiking rates for, at least maybe once or twice more from here. Last week gave us a bit of more confidence that might not be the case. So, particularly the non-farm payrolls report you mentioned on Friday, that was pretty soft, signs of unemployment rising. Some of the survey data also a little bit softer at the margin. So I think it was increasing confidence that not just the Bank of England and the ECB might be near a peak, but also potentially the Fed's getting there. So, absent a kind of oil shock coming out of the Middle East, that should be pretty good for markets. And you certainly saw a big relief rally on the back of that last week.
In last week's podcast, Simon Doherty highlighted that October proved to be a difficult month for investors, and that came with the exception of gold and short-dated gilts, given their defensive qualities. We did get a bit of an uplift in equity and bond markets last week, and notably following the Federal Reserve's interest rate decision. And the US equity markets had the single biggest day rise for 6 months, up by nearly 2%. Overall, it has been a difficult start for the final quarter of the year, and perhaps because of growing realization that interest rates are likely to stay higher for longer than initially thought. But overall, this has just been a continuation of the underlying trends that we have seen over the past 18 months or so. So, Richard, it's perhaps not that surprising. We are seeing a degree of volatility as investment sentiment changes rapidly and ebbs back and forward between optimism and pessimism as new data and news flow emerges. So what are your thoughts on the outlook for the various different financial markets that we can invest in for the rest of 2023 and perhaps early next year? Are we simply waiting for inflation to fall to a level that interest rates can finally start to be cut? Or are there any other catalysts that could perhaps at least give investors grounds for optimism? And if not, and the outlook is going to be take longer than expected to improve, should investors be retreating to cash where they can now at least get relatively attractive returns?
Well, I don't think it's unusual we should have a bit of volatility now. You've had rates go up, very aggressively over the last year or two, and we now seem to be entering a different kind of narrative, particularly where people are more talking about, okay, yes, higher for longer rates, but an environment where we're not quite sure if central banks are going to keep going or are done, and there's increasing talk about potential cuts on the horizon. You've also that sentiment's going to flip back and forwards every week as we saw last week, and then you've also got the issues in the Middle East, Israel, Palestine, all the rest of it that does concern people and could lead to a bit of a jump in the oil price, as I said. So it's not surprising we're seeing a bit of volatility. I mean. I would be reasonably optimistic, though, that, as I say, central banks are pretty much done. Yes, rates may stay higher for longer, but there's plenty of evidence on the inflation front and all the rest of it. They don't really need to be doing too much more. So, I think investors can feel fairly positive as we sort of go into the end of the year about that. We don't want to see a rapid slowing in the US economy, obviously, or in UK and Europe, but a little bit of a slowdown in some of the payrolls numbers. That's all good. That means that the Fed will be, as I say, the Fed can be confident they don't need to raise rates anymore. So I think, a little bit of a slowdown, a soft landing in the economy could be good for equities, could be good for bonds as well. So, I'm not going to sort of dismiss those potential cash returns you mentioned. 5%, it's very, very attractive, particularly compared to what we had last few years or so. But I think with a sort of gradually slowing economy, rates peaking, then, there's plenty of optimism for investors as we head into the end of the year. I think increasingly the theme next year is probably going to be are we going to see rate cuts and where are we going to get them? But also politics is going to be a big issue. UK elections and the US election at the end of the year. So lots to look forward to. But I think for now should be reasonably positive.
Thank you, Richard. So Nick, you're going to be shortly heading to Asia for a research trip. And I understand that you're going to be visiting the main financial centers there. I know that Ben Barringer, our technology analyst, also has regular trips overseas and notably to Silicon Valley. Could you tell us a bit more about your plans and more generally what these research trips involve and what your team gets out of these site visits?
Yeah, thanks, Andrew. So overseas research trips, I guess you would say, have been a core part of our research effort over the years, whether that's our direct equity team, and you mentioned Ben there, or the fund research team. And, for the fund research team, we've looked to make annual trips to the to US and Asia. Obviously, COVID interrupted that. So actually, this is our first trip back to Asia since I went to Tokyo in November 2019. So, it'd be really interesting to see what we, how things have changed. On my agenda this time, so we're heading to Tokyo, to Hong Kong, and to Singapore, and I'm joined by Carly Morehouse, who's our Asian emerging markets analyst. Agenda always varies, but for me, what we're looking to get out of this is firstly, it's as you'd expect, a number of visits to fund managers on site, whether that's fund managers we own or maybe those we want to own. And when you're on site, it's a chance to meet the wider team much more easily. Also see managers who perhaps don't come through London so often, or maybe even at this stage, they don't necessarily have anything which is actually investable in UCITS form. So it's a bit more speculative, provides some different insights, but what I've learned over sort of many trips over the years is sometimes you're meeting a manager that doesn't have something investable or is a little bit different, and down the line, actually, we keep a relationship going, and perhaps it does end up in a something that we end up investing in, and it certainly gives us a different perspective. And then alongside sort of that sort of bread and butter of meeting fund managers, we mix it up with meeting with, so for example, local economists, industry participants, and also accompanying our fund managers to underlying company meetings. So we sort of both see the fund managers in action, but we also get a sort of greater understanding from those companies. So I suppose, what is the aggregate of that? Well, we're really trying to get a rounded picture of the region, of the asset class that you simply can't get by sitting in London, or at least not quite in the same way. So for example, what is life like on the ground in Hong Kong these days? We've heard a lot about it. China is constantly in the news. We saw some sort of lots of sort of changes in recent years there. So it'd be really interesting just to find out actually, what is life like there. And we also hopefully will come back with some new investable ideas within the fund space across Japan, Asia, emerging markets.
Nick, that all sounds very exciting. And Asia is certainly one of my favourite holiday destinations. And having visited and travelled around the region extensively, I can understand the appeal from an investment perspective. You can see the potential for economic growth, and in particular through the emergence and growth of those affluent middle classes, which is very visible in many Asian countries. But what is intriguing me is your trip to Tokyo. Japan is, of course, a highly advanced country and is the world's fourth largest economy and member of the G7. But despite that, the economy has been blighted with low growth, low inflation. And in terms of Japanese stock market returns, performance was very strong in the post-Second World War period. But having peaked at the very end of the 1980s, this was followed by a downward trend that lasted over 20 years. And whilst I'm not old enough to remember the bull market, I do recall that interest in Japan as a recovery theme would emerge throughout the investment management industry, but usually failed to materialize. In fact, this happened so many times during my investment career that I started to refer to Japan as the land of the false dawn rather than the rising sun. But to be fair, Japanese stock market returns have actually been pretty good since the financial crisis of 2008, 2009. But the main indices have still not got back to the all-time high levels seen at the end of 1989. And the economy has continued to be characterized by low inflation and low growth. So, Nick, you obviously think that a trip to Japan is worthwhile, otherwise you wouldn't be going. So what is the sort of current thinking about Japan from an investment perspective?
Yeah, thanks. I have to agree with you. And having spent probably about 20 years of my investment career, at least looking at Japan, it's not always been the first port of call for investment managers like you to call me up. But I've always found it interesting. I always remind people that the amazing statistic that Japan was, I think, 44% of MSCI World back in around about 1989, just at the peak of the what was clearly a bubble, but amazing when you compare to today. But sort of maybe just taking a look at the last decade, I mean, it's definitely been disappointing for UK investors, and this year's certainly been better. But I think an important point to note is actually earnings growth over the last decade in Japan has actually been pretty strong. It's actually not been too far off what you've seen in the US, given, depending on what time period you take. What hasn't happened in Japan has been the re-rating of stocks in the way that you've seen in the US. Plus, if you're a UK investor, you've had the depreciation of the yen, and so that's impacted your sterling return. So completely agree. False dawn is probably the phrase that is most used, and plenty of skepticism, I'd say. So what's interesting about Japan today? Well, it's certainly had a good year so far. As I say, not so much if you're a UK investor, but still, it's been a strong performer. I think looking forward, there are a number of things to consider. So the first one is yen weakness. As I say, that's impacted your sterling return, but the yen is really at quite an extreme today, and there are different ways of measuring this. But if you take the sort of purchasing power parity, or maybe even the good old sort of Big Mac index, we're at multi-decade lows today. So, whenever we're talking about something that is at multi-decade lows, there is that possibility of seeing the reversal, and of course the differential in bond yields globally has been the key driver here. And so, we're sort of better in some respects. We're looking at the Bank of Japan and when it might sort of continue to change its policy, and that's certainly something that is very difficult to predict. But I think we're looking at the long-term opportunity here, the structural opportunity. Now, I'm sure sort of some of your listeners might point out, well, yen's strength often coincides with with market weakness, and that's primarily the exporters. So some of the largest Japanese companies are large exporters, and there's a clear correlation there. But so from our point of view, just thinking about how you might how you might invest, how you might bias more towards the sort of domestic part of the Japan story is sort of clearly something we're thinking about. Another significant impact today, corporate governance. Now, we've been talking about corporate governance improvements in Japan for a decade, since Abe took power in 2012. But again, big move forward this year in terms of proposals from the Tokyo Stock Exchange that are requiring companies to come out with proposals if they're sat on a very low valuation, a very low price to book, or if their return on equity is very low. What proposals are they going to put forward to the market to address this? And it's very interesting when you hear investors, fund investors of all styles, whether it's sort of the deep value managers or those looking for the highest growth companies, all really pointing to this as being a significant driver. I was fortunate enough to meet the CEO of the London Stock Exchange, and it was interesting to hear that since they put these proposals forward, they had a lot of communication from companies who were sort of looking to see exactly what they might need to do. So I do think that is a real driver. And then inflation, that's moving up in Japan. It's been around about zero. We've seen some deflation in Japan over time, and for about the last 30 years. But Japan is arguably a part of the world where inflation is a positive. I don't think we can really say that about many other regions, but aiming for the 2%, as the Bank of Japan has been for a long period, that we're above that at the moment. I think that's just really about ungumming the economy. It's about making corporates who have huge cash balances or individuals who are holding cash, which has been absolutely the right thing to do, to think about how they might use that better. So all of these things, I think, are long-term sort of structural drivers. And with that, we've seen interest from activists, we've seen private equity, we've seen M&A, so there are lots of things at the margin. So let's bring this all back to the trip to Tokyo. I was there in 2019, so interesting to see how things have changed. But I'm looking forward to hearing from fund managers on the ground. We're meeting some underlying companies with a couple of our fund managers, and I'm also meeting with a couple of individuals who are very sort of focused on that corporate governance story, and really just trying to understand if this is a sort of a real shift, and what the impact of the changes are there. So lots to take in. And looking forward to coming back and sort of sharing some of those insights internally and with our clients.
Great, thank you, Nick. It sounds like it could be time for me to sort of rethink my views and perceptions of Japan, and I certainly look forward to hearing about your trip to Asia in due course. So thank you to Richard and Nick for those great insights, and to you all for listening. Did you enjoy our discussion on the podcast today? We love to hear from our listeners, so please review the show wherever you're listening and share it on your socials and tag us at Quilter Cheviot. To make sure you don't miss a future episode, tap the subscribe button. We'll be back next week, and in the meantime, head over to our website, www.quiltercheviot.com, where you can read the accompanying market overview, as well as subscribe to our weekly comment newsletter. You can also stay up to date with our thoughts on market views, industry insights, and our upcoming events and webinars on our website or our social media pages. Finally, if you have any questions you'd like to ask one of our experts for our next podcast, then simply ask them via the weekly comments page on our website. We love to hear your questions. And that's it for today. So thank you again to Richard and Nick for the time, and to you all for listening. See you next time.